ValueQuest Investment Advisors. Let's take our conversation forward. Ravi, I know I can count on you because I know today you'll be smiling. Nobody smiled from the morning, but when markets go down, long-term investors, they get time to get good entry levels. So let's start with a smile on your face because I've not seen any guest at least smile on the show so far.
Thanks, Nikunj. Thanks for having me on the show. Honestly, the smile is not because the market is falling, but nevertheless, I think what everybody is fearing is that everybody is making the mistake of extrapolating the US inflation onto us, and the way the US interest rates are rising onto India, and the way US markets are falling, we will also fall in the same way. I think what we have demonstrated in the last 1 year is that India is anti-fragile. And I use the word carefully because a lot of people use the word decoupling, a lot of people say resilient, a lot of people use different terms. But I don't think we are decoupling. We cannot head in a different direction than what the mothership US goes into. Neither are we just showing resilience in terms of falling less than the world. But when the falling stops, if the market, world markets were to go up 1x, we will go up 1.5x. That is the kind of resilience and outperformance that we are showing in the face of such macro headwinds. So I would say India is anti-fragile, and there are good reasons why we are showing this kind of outperformance. So the smile is more that India will do well in this world where there is all kind of uncertainty around.
Price action has been nothing short of breathtaking. And I distinctly remember when we spoke last, that time you said if you buy the fall in the month of May and June, you will be laughing in the second half of this year. That comeback has happened. But what happens now? We've outperformed, we've done rather well, but the world is connected. If there is going to be an energy crisis in Europe and there is going to be a huge Fed concentrated attempt to bring demand down, I'm sure directly, indirectly, it will have impact on global growth, export demand, underlying valuations, everything in a sense gets rebooted.
Nikunj, I'm sorry, I lost you there for a moment, so I could capture only the last part of it. If you can just summarize the question again.
I spoke to you last. Global markets and Indian markets were in middle of a strong wave of correction, and your idea that time was that you buy in the month of May. This is not the traditional May where you sell in May and go away. If you buy in the month of May, you would be handsomely rewarded. So India has done rather well, but suddenly the macro headwinds which you just referred to are only getting multiplied. So my question is that whether it is energy or whether it is interest rates, in a connected world, I'm sure it will start having impact on global growth, and growth goes down, it's bad for everybody.
Absolutely. So no denying that fact that the inflation is proving to be far more sticky in US. And if inflation is going to be sticky, then interest rates in US are going to go up. And if that happens, then worldwide there will be an environment of risk averseness. However, having said that, and obviously that will impact more directly India on the export front, but it is more exports of services front. I think India is in a different cycle, whether it is compared to in the manufacturing cycle, Capex cycle, real estate cycle. We are in a far different cycle than where the world is. I think a couple of days back, Akash Prakash had also written an article saying that we are at the opposite end of the real estate cycle as compared to China. I think that's absolutely true. But that's not only the case only on the real estate, it's true on the manufacturing cycle front as well. So see, the crises are not a new thing. We have experienced so many crises. In fact, last 10 years are skewed with so many things going wrong, whether it was self-inflicted wound or something that was that emerged externally. But India has found a way to survive that and thrive in that environment. And somehow, luckily, the things seem to be falling in place for us, even in geopolitical context as well. I'm not sure how much credit should go to the government, but I am definitely enjoying the benefits of that. So in a scenario when people want to move out of China, their manufacturing supply chain, in the environment where the energy bills in the Europe are shooting through the roof, everything points to India being the only choice of manufacturing destination, which is large enough to take the kind of shift that is happening in that world. So every earthquake that is happening elsewhere in the world is leading to people looking at India even more favorably. So I am actually very, very enthused by that fact. So we are on the cusp of a manufacturing renaissance. We are on the cusp of a Capex revival, and we are on the cusp of a credit growth cycle and real estate cycle in India.
Ravi, hi, this is Anisha also joining into the conversation. So given the fact
Hi.
that you're talking about how India is looking a bright spot, is it time now to avoid the, export dependent sectors, the likes of IT, pharma, etc., and probably look at capital goods, Capex theme, etc.?
Yeah, so I will not broad brush the whole thing, but definitely at this juncture, pharma has its own challenges, and the challenges are more that their buyers in pharma are consolidated. IT definitely will face a challenge because we saw a tremendous expansion in margin and big pickup in growth. To some extent, that growth was bunched up because of COVID, and now with the COVID normalizing, some of that growth could also go away, and some of the costs that had not been there during COVID times, like travel and all, can come back. So the margins are getting impacted. So I would say IT definitely faces at least 2-3 quarters of pain in terms of margin and a little bit of slowing down of growth. Pharma has been in a challenging phase for most of the last 3-4 years, except for a few quarters during COVID, where again some amount of temporary demand spike had come. But this again, I am not saying that this is the export basket to avoid, but there are other export baskets which are actually doing well. So manufacturing exports are picking up, engineering exports are picking up, defense exports are picking up. So those are the places that one should be focused on from the exports point of view. But again, coming back, I am looking at essentially companies that are more domestically focused. If they do have a export play, well and good. But if you want to look at companies that are linked to the domestic cycle, because that is where the revival is happening.
Companies linked closer to the domestic cycle, that's what you're looking at. So what would fit that build? And if we were to get a little bit specific, would it be, companies within the defense space or some soft Capex themes, capital goods or infrastructure, real estate?
So, across the board, capacity utilizations are rising, whether it is steel, whether it is cement, whether it is engineering goods, whether it is power. Everywhere the utilization levels are rising. For example, power had 69% PLF in the last month, which is the best ever since a long, long time. So that is telling you that even in thermal power, some amount of Capex is going to happen soon enough. Yesterday, somebody from the industry made a saying that we will need additional 32 gigawatt of thermal power by end of this decade if we want to, kind of absorb all the new renewable capacity that is coming in. So the Capex cycle this time around is different from the 2003-8 cycle in the sense that there is thermal power Capex is much, much lower in quantum as compared to that cycle. The bigger chunk is being taken by renewable. But even though thermal power Capex, which was on a decline for the last 10-11 years, is going to see a small revival from an annual addition of 1 gigawatt. It is going to go to 5-6 gigawatt kind of an addition over the next 4-5 years. So sector by sector, there is an increase in capacity utilization. The number of newer companies being registered, number of environmental clearances coming up. All these are lead indicators that the Capex cycle is about to pick up. So one of the things that we track is the cash flow from operations to the Capex done by the company. And this number is at almost a 3-decade high. So we have not seen this kind. So companies are making profits since last 2-3 years, 6-8 quarters, but they are not commensurately investing in Capex. Now, some of it could also be because that Capex intensity could have gone down in that industry because there is a larger automation happening. At the same time, but I feel this number is unsustainable and there has to be some amount of Capex pickup happening. So yes, sector specific Capex is going to pick up. The overall numbers might still not look that attractive for a year more.
If one looks at the underlying valuation, while there is 110% merit, I wish I could say 1000% merit in what the big picture you've shared. Capex, utilization rate, all of them, that is picking up. But some would argue that Siemens is trading at a P multiple of 50 plus, ABB 60 plus. Some of these stocks are at a multi-year high.
So no doubt about it that market has sensed this way back. It's not like today that, so today the actual event is panning out in terms of Capex picking up or the order book for these companies going up, but market recognized this much before. However, having said that, this multiple that you see sometimes 50, 55, 60 times can be a bit misleading because it is on a low profit base. So if you see the profits of the companies as compared to the peak that was achieved in 2007-8 cycle is at the same level or just about higher than that. So the profits are yet to be picked up. Overall utilization levels are low. Material prices are falling down now. And so some amount of gross margin improvement and operating leverage is still ahead of us. And the tailwind or the visibility in the sector is there for at least 3 years. So that tells you that the profits are going to come better and better and better over the next 8, 10, 12 quarters. If that is the case, then some amount of derating might happen, but still the absolute prices will still go up from here.
So Ravi, what is your current portfolio strategy? There are tactical ideas and there are structural ideas. Tactically, where are you smelling an opportunity, and structurally, where have you invested big money?
So as we spoke last time also, we shifted our portfolio majorly in favor of domestic cyclicals. And when I say domestic cyclicals, I'm talking about financials, auto ancillary, capital goods, defense. These are the sectors in which we did not have much of an exposure, say around 8-10 months back. And that is where we have increased our exposure. And we have reduced our exposure to pharma, chemicals, IT, platform companies or capital markets linked platform companies. Those kind of places is where we have reduced. And again, this was precisely because of the way valuations had moved in those sectors and also the way the macros were panning out in this. We could foresee that the tailwinds are building up over here, and hence we moved our portfolio towards this. This is again from a 2, 3, 4 years point of view, not necessarily a tactical bet from 3-6 months point of view.
Ravi, wanted to deep dive into what you said about IT, right, and how your view has changed over the last 1 year, because you did hint that in the near term there is going to be a bit of pressure. So how are you approaching the entire IT sector at the moment? Is it a fresh buy given the deep correction that we have seen in the prices?
So honest admission over here, we actually missed the bulk of the IT rally last year. So we were never invested heavily in IT, but we did have some exposure to IT platform companies. Having said that, I think even there we have reduced our exposure, and the precise reason being that we believe a lot of the growth that we saw last year will get corrected. Now, that was a temporary blip because of the way everything got bunched up, and that unsustainable growth or unsustainable margins were getting a very high multiple. Now the earnings and growth are going to adjust. At the same time, multiples are going to adjust as well. So I would say at least another 2-3 quarters. And the way the attrition problem is still persisting, I would say the margin impact will still be showing for at least 2-3 quarters. So from that point of view, we will keep monitoring the situation, but there is no desperation to start building position in IT yet. Having said that, it's a secular theme, the digitization, and at some point of time, these businesses will become attractive again, and one should start looking at it again.
Space that we haven't talked about is the entire financial space, and given the fact that you're quite bullish when it comes to the Capex theme, doesn't it warrant a fresh look for the entire financial space as well? Because even if you look at the public sector banks, a lot of the metrics are at a decade or 2-decade high.
No, absolutely. We are very, very bullish on the financial space, and especially the lenders, whether it is private banks or smaller banks or NBFCs. We do not have any kind of an exposure to PSU banks, and that is nothing to do with the valuation. It is everything to do with my interest not being aligned with the promoter, which is the government of India in this case. So they have social objectives besides the capital market objectives. So that does not meet my criteria well. However, having said that, if I do feel that government is also aligned to consolidating the sector and making sure those banks become bigger and bigger, and actually they function in a truly capitalistic way, then I think even those will warrant a buy. Our exposure is more in those private banks where we do not see any kind of overhang, whether it's in terms of a merger, whether it's in terms of a promoter changing, or whether it's in terms of a whole management undergoing some kind of a change. So we are looking for stories where capital adequacy ratio, capital raise is behind us, and management change is behind us, and the pathway is clear in terms of growth for the next 3-4 years. And you could see that the 10-12% ROE that they are currently doing easily going to 15 to 18% over the next 2-3 years as credit growth picks up. And the credit growth, what we have seen coming to 15-16% after almost a decade, is a sign that the things are picking up in the economy.
I asked this question to our common friend Hiren Ved yesterday, a question which I had also asked Rakesh Bhai at some point in time, that if the Indian bull market is like a train journey from Churchgate to Kandivali, where has this bull market reached?
So I think we have just entered a new phase. I think it's the train is changing from a slow local to a fast local, and probably we are getting geared towards changing to a bullet train. And I think our destination is changing from Kandivali to maybe going all the way to Delhi. So just in that context, I would just say that we have spent bulk of the last decade in preparing. So whether it was demonetization, GST, coming out of the NBFC crisis, putting in place IBC, those things are all the thing that will help the next decade of growth to be much far superior in quality terms and at a much higher pace as compared to what we have seen in the last 10 years. Now, of course, a tailwind from the world would definitely help our cause much more. Right now, we are struggling and trying to be the best in a world which is kind of uncertain. But there will come a phase when even world is doing quite okay, and at that point of time, India will really accelerate.
Delhi कितना दूर है? If you have to go to the bullet train.
Delhi बहुत दूर है. Delhi बहुत दूर है.
All right, Ravi. Always a pleasure to have you on ET Now. Thank you for joining us. We've got Ravi Dharmashi on a day when